something we thought a few months ago might be transitory is now appearing to be more permanent.
Our sort of original thinking on inflation before we started to see these really high core and headline CPI prints of 4% plus was that, this is going to be transitory. It's going to be tied to the reopening. So, we start out and we look at the CPI and we break it into its components. We've showed this chart before. The purple line is the elements in the CPI basket that we term the reopening bucket. So used cars, hotels and motels, airline fares, car and truck rental. And those things all tied to the reopening, up 40% year over year, were a massive contributor to the core CPI. And you look at all of those items and you think the prices of these things aren't going to keep rising at this rate forever. They're going to turn over. And that's why this inflationary spike is going to be transitory. Once the economy reopens, these issues will get worked out and we shouldn't have to worry about this. But now that there's more and more information and there's more and more things going on in terms of supply chains and the labor market and the housing market, the biggest question for us is, okay, we're not going to have 4% core CPI most likely going forward. Yes, it's transitory, but when it settles back down, where does it settle to?
Mm-hmm.
We're used to, for the past 10 years, inflation running below 2%. That has certain market implications. Well, what if it runs at 2% plus? So that's the first consideration. Are we just going to settle down to a higher level? And we think there's a chance of that. And then the second thing is, where are the risks tilted? We're used to the risk being deflationary. So inflation undershoots persistently. What if the risks are tilted to the upside? That has market implications as well. And so, we can go through what's happened in the housing market, the labor market, and supply chains. These are becoming very sticky issues. If they were truly transitory, they might have been resolved by now, but they're clearly not. In fact, they're getting worse.
And just comment on this chart in particular, the pretty rapid increase in commodities as a component.
Right. Yeah. So commodities, the Bloomberg Commodity Index, for example, up 40% year over year. These are the commodities that are in the CPI basket, the core CPI basket, so not food and energy. And you're still looking at up 8% year over year. And, commodity prices, you would think commodity price increases are transitory as well. The classic saying is the cure for high commodity prices is high commodity prices. Because as commodity prices go up, that incentivizes producers to increase production, increase supply of commodities, because they're going to get paid more to do so. So what we're monitoring very closely is, as prices go up, how big is the supply response? Are commodity producers making long-term investments that would increase the supply of all these things, copper, iron ore, et cetera? And the supply response has been very weak. It's been far weaker than you would suggest or see coming out of prior economic recoveries, which leads us to believe that this supply-demand imbalance that's creating upward pressure on many commodities, it actually could persist for longer than you might expect. Mm-hmm. And once again, we're coming out of a 10-year period where commodities were in a disinflation. If commodities are in a inflation or boom super cycle over the next 10 years, that has far different market implications than what we're used to.
So let's dig in on CPI and look at rents and housing prices and the impact.
And we think the housing market is one of the biggest reasons why, after we get over this transitory spike, we should be thinking of a run rate of 2% plus, not below 2% like we're used to. And it's really baked in the cake. How the math works out, the green line is home prices in the US. They're up about 20% year over year. How it works out historically, home prices are not represented in the CPI. But what is represented are owner's equivalent rent and consumer rent, so rents of primary residences. And the increase in home prices that you see right now will flow through, approximately a third of it flows through to the rent measures in core CPI over the next 18 to 24 months. These rent measures are 40% of core CPI. So if you do the math, 20% increase, give me a third of that times 0.4, or 40%. That basically means that just the rent measures are going to be contributing 2% plus to core CPI over the next 18 to 24 months. And it's a very statistically reliable relationship. It's sort of baked in the cake. So that's now our starting point for inflation over the next 2 years is 2%, and then we'll go from there.
And talk about how that translates into the consumer experience and their ability to sort of reject those price increases or not, especially with housing.
Yeah, with housing. So this is a great question. At what point do house prices go up so much that you have a buyer's strike? I'm just not going to pay that. This is ridiculous. I'm just not going to deal with it. And we've already seen some signs of that, right? House prices starting to slow because people aren't buying because house prices are so high. So it's a very interesting economic relationship. That's where you go into different phases of the economic recovery. So you think we're talking about the economic principle here is the demand elasticity of goods. So as prices go up, will I buy more or less of these things? Every consumer, when they're considering prices, they're considering it relative to their incomes and their confidence in their future wages. And right now, we are in what we would call the growth phase of the economic recovery. Wages, especially at the lower end of the scale, are rising very rapidly. Incomes and savings are high. So consumers are willing to pay higher prices because they feel like they can do so. And this growth phase might last for a very long period of time. And the reason for that is we know how much money was created in the past 18 months. Well, originally that was just liquidity, but now it's becoming incomes and revenues and earnings and wages. And so all that money's passing through and getting recycled in that way. And so, high prices for consumers, they might not matter for a very long time because consumer confidence is high, they're getting wage increases, and so on and so forth.
Yeah, it's another to point we've talked to in the past that people we think might be underestimating the power of all this money that's been created, and it's massively supporting our outlook as we go forward here, and part of our outlook being sort of reopening phase 2 as we look forward. So it'll be interesting to see how these things play out over the next 18 months, but definitely we believe we're going to continue to see high CPI prints. So other elements of inflation that we're seeing, in particular, shipping costs still remain at an all-time high.
Mm-hmm. Yeah, and we know a lot of businesses are raising prices or they're planning on raising prices. And one of the big reasons for that is anybody who's buying anything overseas, whether it's in China or it's coming from Europe, which is a lot of stuff that we get here in the United States, the cost to ship it overseas is extremely high. And the blue line is the cost to it's freight costs from China to the U.S. West Coast. So think from Beijing or Shanghai to Port of L.A. How much does it cost to put something on a boat and send it over? And that's gone up exponentially because, well, it started off as China was shipping us a ton of stuff during the pandemic because we were all locked in our houses spending money. And normally we send stuff back to them. So they send us the containers and we send the containers back with stuff in them. But we weren't sending them anything back. So we just kept the empty containers. So it started out as just a massive surge in demand during a pandemic. So that was the first issue. Then it was a container shortage in China. And now that's gotten even worse to the point where now there are labor shortages in the US in particular. Even if we were to unload the freight from China, there's nobody there to unload it. And things like Delta variant are complicating the whole thing. In China, they shut down the third largest port in the world because there were a few COVID cases. We don't know exactly how many COVID cases there were. They reported 2 or 3. But as long as that's the policy and that's the reaction function, and you have these shutdowns at these very important, points in the supply chain, these issues are going to keep coming up.
Yeah, I mean, did you see the map of all the ships sitting off of the port of Los Angeles?
Yeah.
It's incredible.
Yeah, it's crazy, and you would need a lot of people there to unload those.
Yeah.
And there's a massive labor shortage, so those boats are going to sit there for a while. So then naturally you think, well, I'm not going to get it from China anymore. I'm going to get it from Europe. But now we're having the same problem. So then you see cost to ship something from Europe to the East Coast starting to rise because Now there's a rush to get everything to sort of reconfigure supply chains and change where you're ordering from. And they're dealing with similar issues. So, these are costs that companies either are going to have to eat or they're going to have to pass on to consumers.
Mhm.
Luckily, once again, we're in the growth phase, so they feel comfortable passing them on to consumers. So that's a good thing for economic growth, but it's not a great thing for inflation.
Right. And they have margins. The margins are really strong right now, so they can absorb some of that temporarily. So right now, I think these things are fine. But like just looking particularly at the next slide on how higher commodity prices are sort of putting the squeeze on producers.
Yeah, and this is US PPI, so the Producer's Price Index. It's viewed as a leading indicator of the CPI, the Consumer Price Index, and this is just for all commodities in the basket. I mean, they're up 20% year over year, so that's the fastest year over year increase that producers have had to pay for commodity prices um, in the last 20 years, 20, 30 years. So even higher than what we saw in '08. So, like you said, luckily companies have margins where they can absorb some of this, and luckily consumers have savings and incomes so they can pay some price increases. Eventually, this will start to matter, especially if these commodity price increases are stickier or longer lasting than folks expect, which is becoming more of our base case.